Welcome to the Catastrophic Economist. I am your host, Breland Clark. And before we dive into our first event, our first cataclysm, a few housekeeping concerns and a few things I want to mention. First off, this wasn't even supposed to be my original first episode to produce. I'm building up a silo of many episodes to push out before, I push out everything else. Matter of fact, I don't even have my mic yet. I was supposed to, maybe start in a couple weeks from now. But I, things are moving so rapidly in the financial sphere, and I saw fit to jump on board right now and get things started. So if there's any audio distortions or anything like that, because I don't have my mic, excuse me, I apologize. But that's not going to stop the show. We're going to keep moving forward. We will be talking about many events here. We will be talking about a lot of things dealing with finance, basic stuff. I'm not a financial expert. I'm not your financial advisor, so please do your own research. That goes across the board in all the episodes I'm going to produce going forward. I will be doing a little trading for myself in the future. Nothing crazy. Buying some puts, and just doing some long straddles. Simple stuff like that. So you need to have just maybe an intermediate knowledge base when you come here. Please do other research on other channels or, any way you can before you come here. We're not going to hold your hand, but it's not going to be advanced stuff either. So also, like and subscribe and, comment right below of topics that you think I should discuss going forward. I will mostly be talking in charts, chart guy and history guy. I love charts, love history. So you're going to see a lot of that on this channel. I'm also going to bring up some news things, nothing too political. I don't like politics outside of things that doesn't directly concern the economic sphere. And obviously, there's a lot of that today in particular. We're going to go over different type of natural disasters, different type of viruses, epidemics, wars, things that happen in the natural world that affect the economic world. So hold on to your hats, boys and girls. It's about to get catastrophic because there are a lot of things that are changing in our world right now. And that's where we're going to focus on here. So let's jump right into it with our first event, our first cataclysm. A lot of people can probably guess what it's going to be. Let's do it. Before we dive into our actual story, let's go over a few housekeeping charts. The first one we have comes directly from the Fed's website, the Fred. This first chart we're going to be talking about quite often. Again, I'm not going to dive too deep into each one of the charts. We're going to talk about more in depth what these charts mean, what they are in the future on future episodes. But I'm going to briefly explain it so we can get into our actual story. So this chart is, again, the 10-year minus the 2-year. The blue line represents the spread of the 10-year bond minus the 2-year bond of the United States, Treasury bond. Every one of those gray streaks right here, bada boom, bada bang, bada bing. These represent different recessions we went through. This is the 2008 financial crisis. This is .com. Right here, around 2000, 2001. As you guys can see, there's a positive territory. Everything above the zero mark on this chart is in positive territory, and there's a negative territory. Obviously, it's in negative below zero. Normally, this chart represents sentiment value in a lot of investors' mind. Everything above zero is a normal yield curve. Normal yield curve. Everything below that is an inverted yield curve. Everything that's in the positive territory, good, economic growth, people are confident. Everything below that is the opposite effect. People may think that there's a recession coming soon. Less growth might be happening next couple months, next couple weeks, next couple years. So that is what this chart represents. As you guys can see, as of late, the yield curve inverted in the last year and a half or so. and it started to uninvert, and now it is slightly above inversion, slightly above slightly above inversion, and is in the normal territory. So nothing, no chart should be used by itself, right? Everything should be used with a grain of salt, grain of sand. But this is something to keep in mind as we move forward. Okay, we're going to talk about the chart a lot. Next, the VIX, the volatility index, kind of speaks for itself. It measures volatility in the overall equities market. We're going to be looking at this quite frequently. But the thing I want you guys to pay attention to as of right now for this episode is January 6th. There is a little volatility since January 6th, and our event might have something to do with that, maybe not. But we're going to look into it. The next chart we have is the Dixie, the US dollar index, also kind of speaks for itself. Also had a fluctuation around the 6th. Again, may or may not be directly correlated to our event. But I will say that there has been a little movement as of late. Nothing to be cautious about right now, but it's something to keep in mind as we're going in. And I just want to give you guys this overview, to set the stage for our event that's taking place, because this is an important event. Again, this wasn't supposed to be my first episode, but I saw fit to dive right into it because it's going to cover a lot of things that we're going to be talking about going forward. And I'm sure a lot of you guys can imagine what that event is. So without further ado, we're going to talk about it right now. All right. All right, you guys, before we dive directly into the story, let's go over a few housekeeping charts. You guys are going to see a lot of these charts in future episodes, but as of right now, let's just quickly go through them. I'm going to explain it in detail a lot more later, but really quick, let's go over these three charts. The first one is coming directly from the Fed's website called the FRED. This is the 10-year Treasury minus the 2-year Treasury. So basically, this chart represents the blue line in particular represents the spread of the interest rates of the 10-year and the 2-year. And as you guys can see, this blue line, it goes through the 0 point. Everything above 0 obviously is in the positive territory. Everything in the positive territory represents a normal yield curve. Normal yield curve means good growth. People, investors are positive about the economy. People have expectations that we're all good. Everything below that, the negative yield curve, represents an inverted yield curve, right? So as you guys can see, there are these gray lines, these streaks that go through them. So these gray streaks represent recessions that we've had. For example, this one's 2008, the bubble then, and this is the dot-com bubble in 2001, and so on and so forth. As you guys can see, there is an ebb and flow, right? It goes up and it goes down. Right? Just like in everything in economics, you got ups and you got downs. It's just a normal cycle. As you guys can see, most recently, there has been a inverted yield curve for the past year and a half, and it's just started to go above into the positive territory. Now, the interesting thing about that is, as you guys can see from the previous recessions we've had, it first dives into negative territory to create an inverted yield curve, and then it starts to steep up and it starts to go back in a positive direction. And that's normally when we actually have the recession itself. So just something to keep an eye out. We're replaying the same thing that happens, over and over again. Obviously, we shouldn't use one chart by itself, right? That's not a good way to create an educated guess or hypothesis about something or a theory. You need multiple charts. You need many things. We're gonna talk about many charts on this channel. But this is one in particular you guys are going to see a lot of. The second one is the VIX, the volatility index. Kind of name speaks for itself, right? This measures the volatility in the market. And right now, as you guys can see, just making sure. Most recently, just to pin in the back of your head, January 6th, that date, as you guys can see, there's been a little volatility up and down since January 6th. And maybe our event has something to do with that. We'll talk about that in just one second. And this is the Dixie. This is the US dollar index, also called a Dixie. This is another way we can measure volatility that happens around the world. So that's another reason why you guys are going to see this chart quite a bit. When countries are going through their own situations, they normally flood into the dollar because they see it as a safety place, right? So obviously, as it goes up, then maybe people are thinking that, hey, we should hold on to dollars. So that's what that talks about. Again, there's been an uptick a little bit and recently down a little bit, but it's been an uptick since January 6th, the day before our event actually took place. All right. Okay, so let's dive into the actual story itself. Some of you guys might have already guessed it. It is the California wildfires. First and foremost, prayers go out to everybody affected by the wildfires. I have friends and family up there, and I can tell you just from hearing them and watching on the news and everything, it seems quite scary to be there, to say the least. So it must be hard for those that are directly affected, the businesses, the homes, the families that are misplaced because of it. So it affected a lot of people individually, directly, but it also is probably going to affect the rest of the country indirectly in a lot of different ways. And we're going to talk about some of those ways now. One industry in particular that I think that is really important. It's really important to cataclysms, to catastrophes in general, to catastrophic economics in general. It is the insurance companies. They're the bread and butter of any type of rebuilding after an event happens. So it's really important to take into account and to measure insurance companies because you insure everything that's important to you, right? Your car, your house, any big purchase you make. Businesses, they may insure important equipment. Construction companies in particular, their biggest expenditure of their revenue is actually insurance costs, right? Similar for transportation industries, similar for utilities. They are very important. Even when it comes to transportation, they insure not just the trucks, but the haul that they put on the trucks, whatever they're pushing from one thing from one side of the country to the other, whatever they're transporting, they also insure that. So it's very important to make sure we understand the health and the growth of these insurance companies, and we're going to keep a good eye on them. But I don't want to get too ahead of myself. Let's talk about the California wildfire first, give you just a quick overview. Happened in January 7th. Just quickly read this paragraph. A handful of wildfires that kicked off on January 7th, powered by high winds and dry conditions, have exploded in size. As of Thursday afternoon, 25 people had been killed and more than 12,000 buildings and structures have been destroyed. More than 160 people are under evacuation orders and warnings. Really quick, this is just another overview that gives them maybe an updated measure of the effects that it's had directly to the people. 15,000 structures. 15,000. That's 15,000 homes, businesses, things that people need to live, right? 28 people died. 40,000 plus acres burned. 40,000. It's a huge fire. It's one of the biggest ones that they've had most recently. And it's devastated the state. And it's also, we're going to keep seeing the repercussions of that as recovery happens, right? As of right now, today's date, most of the flames have been cured. In Palisades and Eaton have the biggest fires that they had to put out. Palisades is 63% contained, and as of right now, an Eaton fire is 89% contained. Hopefully, by the time you guys are watching this, is 100% contained, and we can start. Those people in those areas can start rebuilding their lives again. But moving on, this is a trend that I have been noticing for the last couple of years. Due to climate change and maybe a few other different reasons, there have been an increased amount of disasters that keep afflicting the world, not just our country, but also the world. And this is why this channel is so important. I think this is why it's really important for me to talk about this stuff, because I think these events are going to have a long-lasting contagion effect with our financial markets, right? So, first, our article, this comes from USA Facts. Are major natural disasters increasing? Yeah, they are. You guys are going to see from the study. I'm going to actually put the study below. It's worth reading if you guys can read it, but I'm going to quickly skim through important points and highlight a few things. 9 out of the 10 years with the highest number of natural disasters occurred in the last decade. Obvious trend. Obvious trend. I'm going to go down here. I'm going to read this paragraph really quick. The bulk of these events happened in the past, happened from post 1990. In the 1980s, there were a total of $33 billion natural disaster events with 2,994 deaths. In the last 10 full years, from 2014 to 2023, it's 2025 right now, obviously, this number rose to 173, resulting in 5,872 deaths. All told, nearly 40% of the billion-dollar climate events have hit the U.S. since 1980, happened between 2017 and the present day. This is a quick chart that shows that. Can I kind of zoom out a little bit? No, I can't zoom out on here. But as you guys can see from the chart, I try to get the chart in one at the screen at the same time. But as you guys can see, there's a clear trend. As time goes on, these events happen in increasing amounts and have an increasing amount of devastation to the economy. So obviously, from what you guys can see, the biggest thing that we keep getting pounded by is these severe storms. And probably a second one will be tropical cyclones and flooding, and then maybe wildfires right after that. Yep. So the blue one, yeah, tropical cyclones, which is also hurricanes, flooding, then forest fires. The year just started off, and we already get one of the worst fires that we've had in decades. So it's probably, this trend will probably increase. I want to also bring up one more thing just to show where these events are actually taking place the most in the United States. As you guys can see, the most monetary damage has been done to Texas. Currently live in Texas, by the way. I'm from Louisiana. But Texas has been hit hard. Obviously, it's been a lot of tropical storms in this area, flood, freezes, a lot of things happen in Texas. But that Texas is not the only one. A few other worth mentioning states are Louisiana, Florida, California, obviously, earthquakes. They've had a lot of uptick in earthquakes this year. I've been keeping up a lot with the seismic activity. I'm not a geophysicist. I'm not a meteorologist, but I do follow people that are really skilled. They're very knowledgeable and they know what they're talking about. And they've been saying the same thing. There's been a constant uptick. California, obviously, again, earthquakes, fires, Louisiana, Texas, cyclones, tornadoes, hurricanes. Same thing for Florida, hurricanes. And it's been an obvious trend up. And we have to keep a steady eye on these places because they are hit hard. And let me tell you why we should keep a particular eye on these places. Another reason is because insurance companies are also, contributing to, the rebuilding of these areas. And, it's hard to determine, obviously, from these insurance companies, what places are more at risk and less at risk, because that determines your premiums, that determines your type of coverage you're going to receive. Insurance companies' whole platform of business is moderating risk, right? They have to understand how to quantify it and try to make sense of it, because they don't want to, get into a market that it has a whole bunch of events and, they can't fund it, right? That's bad news. Right now, Allstate is an insurance company in particular that's being hit hard in California. Also, they aren't getting good exposure right now. There's been a lot of critiques their way. People think they should have handled things differently, and they've been pulling out of the market. And we'll watch a video that talks about that in a second. But again, these companies, these insurance companies, their job is to understand risk. And if these risks are increasing, they don't know how to measure it anymore. These events like this fire that just happened, it was obviously they have fires in the past, but to say that they knew that it was going to be this devastating, walking into that market, I mean, obviously they they didn't know that, or obviously they kind of did because they started pulling out before, a couple weeks, before. Not that they knew about the fire or anything, but they know that risk is increasing, and it's getting harder and harder to understand that risk because new events are happening in new places, and also the events that are happening there before, right? It's hard to quantify how bad it's going to be. So why would they stay there? And that's very important. Insurance companies are vital. They are the cushion behind each one of these events. Let's say, for example, these insurance companies in California, let's say they can pull completely out of California because they don't think the risk is worth having. That risk is going to shrink the pool of people, of coverages outside of California. And the people outside of California are going to have to pay higher premiums to keep their insurance, right? Because, insurance is pooled, right? It's a pool of money that they take from you via premiums, and they use that pool to be able to pay people back. Well, what if they decide to pull out for good reason, maybe? Really quick, I said Allstate, but I think I meant State Farm. State Farm is in California, and they're getting a bad rap right now. But this is Allstate. This is a market we can actually watch, a company we can actually watch. State Farm is actually a private company. They're private. They're a great company, State Farm. And I have a lot of great things to say about them and the way that they measure risk. But unfortunately, they're also private, and maybe they're underfunded. Is another thing that I would like to say right now. What if we can't see their balance sheets, we can't see their 10K or anything like that, but what if there's a situation where they are underwater already, and these catastrophes, the more and more they occur, they take a big hit, State Farm. State Farm makes up about 20% of the overall insurance, house, car insurance industry. They take up almost 20%. They're the biggest they're the biggest company in the market. They take up most of the dominance of the insurance market. So, the insurance and real estate and insurance real estate adjacent industries take up about 20%, 20 plus percent of overall US GDP. So if something happens to these insurance companies, it will directly and indirectly affect the rest of the economy. They're already projecting a downtick of 0.1 to 0.3% downtick in the US GDP because of the event that just happened in California. So it's important that we keep a close eye out on these companies. And yeah, first off, this is Allstate. They've been struggling a little bit, but they are made an uptick since everything that happened January 6th. So the companies are recovering, but of course they're getting a bad rap right now. This is State Farm. This is State Farm Growth Fund. Obviously, again, they're not a public company, so we can't, they don't have stock, common stock. So this is just a fund. It kind of maybe loosely represents. As you guys can see, there was an initial downtick on January 6th, 7th. Went down, and now it's starting to pick back up. Hopefully, they're getting some help out there. But let's watch this video really quick to dive more into the
Here's how I got my team to use Monday
crisis.
Sales CRM and actually like it. Let me start by saying, as a large
Despite living in at-risk areas for wildfires, thousands of Los Angeles homeowners do not have home insurance. This disparity, highlighted by the current fires, is because several private insurers in California have either raised prices or have removed their coverage completely. For example, a spokesperson from the California Department of Insurance told CBS Money Watch that State Farm dropped around 1,600 policies in Pacific Palisades last July. That town now obliterated. State Farm telling CBS News, quote, "Our number one priority right now is the safety of our customers, agents, and employees impacted by the fires, and assisting our customers in the midst of this tragedy." Catherine Boudreau joins me now for more. She's a senior sustainability reporter for Business Insider. Catherine, thank you for joining us on this crucial topic. Help us understand what led some private insurers, to increase their rates or remove coverage from high-risk areas altogether.
Thank you so much for having me. So, the surging costs from more frequent and intense disasters, coupled with the rising costs of repairing homes and the cost of inflation, has prompted a lot of private insurers to, like you said, hike rates on homeowners in states across the country, particularly in California, or drop them altogether. They say that the insurance market in California has become unsustainable, and that's why some homeowners are, are getting dropped, or in some cases might be foregoing insurance altogether.
Some are describing this as a home insurance crisis, not just in California, but in Texas, which deals with intense ice storms, in the Carolinas, which were recently flooded. Folks in Congress have attempted passing legislation that would address this, but yet it persists. What is the most popular solution, and how long could it take before there is relief for homeowners?
Mm-hmm. Yes, well, I think California in particular, they do have an insurer of last resort. This is what's known as a FAIR plan. At least a dozen states have them across the country. In California, it's regulated by the state, but it's backed by private insurance companies. And unfortunately, these FAIR plans, while they are a last resort and a good option, they are more expensive and tend to cover less damage. So you want to have more homeowners in the private market. And unfortunately, as companies like you mentioned, State Farm, Allstate, are dropping homeowners, they're increasingly turning to these FAIR plan policies. And then, maybe they'll search for alternatives on the private market, but they're becoming increasingly hard to afford and find.
And you may have touched on this, Catherine, but in our last few seconds, if someone watching is a homeowner in an at-risk location and their insurance is lifted, what should they do?
When you say their insurance has been dropped, hopefully that if they haven't been able to find insurance, but in between the time that they've been dropped and this devastating wildfire, there is, I'm sure, FEMA assistance that's going to be available from the federal government. Unfortunately, that's not going to cover all insured losses, but that is designed to be a backstop as well.
Becoming a more common issue, we really appreciate your guidance on this difficult topic, Catherine.
So, like I mentioned, the insurance companies are very vital. Just a little background about these insurance companies. Obviously, they get their revenue, their income from premiums that people pay to be insured. So insurers pay a premium, and in response, insurance company gives them that coverage that they're looking for in case of an event happens. So these insurance companies also have entities called reinsurers. These reinsurers help mitigate risk outside the insurance company themselves, like Allstate or State Farm. These reinsurers are the insurance company's insurance. So if a big event happens and they feel like they can't pay for it themselves, then they go to the reinsurer to ask for help to help support them. An insurance company diversifies its income geographically, right? So you're having, getting insurers from California and Louisiana and Maine. And so first, when they start pulling out an area, it shouldn't be taken lightly, because first and foremost, that's them, narrowing down their income, right? They can only get it from a few places. And like I mentioned, that's going to bring up the premiums in the places that are left over, and that actually can actually be covered by the insurance. Now, what this is going to do, or what I believe, it's going to cause a lot of different issues outside of financial as well. I think it's going to cause a lot of migration with homes, with people living in certain places, and also businesses. If you can't insure avocados that are transporting, from California, if you can't insure the load, then why would you do business in California? Why would you have your business avocado farm there, outside of the climate, obviously? But, people and businesses are going to have to reconsider a lot of things in order to be able to afford and even have the ability to get coverage from insurance companies. And if these companies can't insure their equipment and it breaks down, then how would they be able to replace it? Some equipment costs a lot of money, right? So it's very important. It's a very fragile system, the insurance companies, and they are hurting right now. Okay. And let's go to our next page. So really quick, going into our next article, this is from Miss Boudreau. It's the Business Insider, from Business Insider. The article's title is "America's Home Insurance Problem is Set to Intensify." Again, you guys can see this article and the next article that I'm going to bring up right below. I'm going to put that information so you guys could read the whole entire thing. But I'm just going to quickly go over one or two paragraphs here just to explain just the overview and to talk about the next subject, the sub-subject. So the numbers are rising because private insurers are pulling back coverage and hiking premiums in areas at risk, and wildfires, hurricanes, floodings, and other disasters, often made worse by climate change. While state mandate FAIR plans are designed to be a backstop, insurance regulators and private insurance companies are alarmed by how many homeowners and businesses are enrolling, especially in California and Florida. The plans are often more expensive and provide less coverage. So they're more expensive and they have less coverage on them. Plus, saddling one insurer with the riskiest policy increases the changes of one major disaster sinking the system and leaving taxpayers and insurance companies with the bill. So from this paragraph, they're talking about, first off, this FAIR plan that she just mentioned basically is a pool that states use. This pool is mandated by the insurance companies in that state. Let's say California mandates Allstate and State Farm to pull in money to help to create a revenue source for the state provided insurance company, right? So as well as the premiums that people pay into it. But the premiums that people pay into it, it's inefficient because, it's more expensive and oftentimes it covers less things. This is something very important to consider moving forward. We're going to keep an eye on this. And like I mentioned, a lot of these people are struggling obviously already because affordability of homes and cars are already at their highest. And insurance companies, have to insure these things. So the individual person is also paying a lot on the insurance for your homes and your cars. So this is something to obviously keep track of. This is an article really quick. This is a study from Joint Center for Housing Studies of Harvard University. This is also a really good article, really good study. I'm going to just touch on one or two things and close it out for today. Really quick, first of all, the name of this article is The Insurance Crisis Continues to Weigh on Homeowners. All right. And really quick, with increasing costs, there is a growing home equity protection gap. In 2022, an estimate of 12% of homeowners did not have homeowners insurance. 12%. This occurs at the time that the share of homeowners without a mortgage and associated lender insurance requirements remain above 40%. Expensive. These figures do not take into account the sizable share of renters who lack renters insurance coverage for home contents. So this is just the insurance just for the house, the shell, not even the stuff inside the house, right? All the prices of things are going up, also the insurance costs. Most households buy their coverage from the private insurance market for a homeowner's insurance, though their insurers may also bundle in public hazard insurance policies, such as the National Flood Insurance Program. As a result of market conditions, private insurers have faced unprofitability, insolvencies, and are exiting markets altogether in states like California, Louisiana, and Florida. Some industry analysts question whether homeowners' line of business is even profitable at all, following years of underwriting losses and rising replacement costs, like I was mentioning. Within states, there is considerable variation across insurance pricing, leading to consumers to shop around, maybe even migrate out, as I was saying earlier. Risk-based pricing reflects expected damages from covered perils, but often leads to unaffordable premiums. Alternatively, underpricing policies relative to true risk can enable risk-seeking behavior, such as further development in high-exposed regions. So even if people stay in these regions where these more intensely, more frequent events are happening, even if you choose to stay there, prices of those replacement, things are going to go up. So if you're out there and you're a business or you're a family out there, it's going to be terrible for you because you got to replace that yourself. You're still stuck with the